Look at the charts of the most viral meme coins from 6 months ago. They aren't just down, they are bleeding liquidity into a void. The era of pure speculation is hitting a wall because smart money is no longer satisfied with tokens backed by nothing but social media sentiment. We are witnessing a massive silent rotation. Institutional investors and sophisticated yield hunters are moving their capital into a sector that grew by over 400% in the last year alone. This isn't just another crypto trend, it is the fundamental re-architecting of global finance. We are talking about real-world asset tokenization, or RWA. While the retail crowd is chasing the next dog-themed coin, the titans of Wall Street are quietly moving. To understand the scale of what is happening, we have to look at the projections. Boston Consulting Group and HSBC have estimated that the tokenization of illiquid assets will reach a $16 trillion market cap by 2030. That is 10% of global GDP. Why now? Because the infrastructure has finally caught up with the ambition. For the first time, we have the regulatory frameworks, the high-speed Layer 2 networks, and the institutional-grade custody solutions required to handle massive off-chain value. The shift is simple. The market is moving from trust-less assets with no value to trust-minimized assets with massive cash flow. Every high-rise, every gold bar, and every treasury bond is.
But how do you actually put a physical building on a blockchain? You cannot just upload a brick to Ethereum. This process requires a sophisticated bridge between the legal world and the digital world. It begins with the creation of a special purpose vehicle, or SPV. This is a legal entity that holds the deed to the property, or the title to the asset. The ownership of that SPV is then represented by thousands or millions of digital tokens. These are not just entries in a database. They are legally binding claims to the revenue generated by that asset. If the building collects rent, you collect yield. If the gold increases in value, your token reflects that price. It is the democratization of the billionaire's portfolio.
Fractionalization is the engine of the RWA boom. Traditionally, if you wanted to invest in a $50 million commercial plaza, you needed a massive network and even bigger capital. RWA protocols break that $50 million asset into 50,000 tokens worth $1,000 each. This unlocks liquidity in markets that have been frozen for centuries. It allows a teacher in Jakarta and a fund manager in Zurich to share ownership of the same London skyscraper. But more importantly, these tokens are composable. You can take your tokenized real estate and use it as collateral in a DeFi lending protocol to earn even more yield. It is the ultimate capital efficiency. The biggest challenge in RWA is the oracle problem. How does the blockchain know the building hasn't burned down or the gold hasn't been stolen? This is where decentralized oracle networks like Chainlink come in. They provide a secure data feed that bridges off-chain reality with on-chain smart contracts. Through proof of reserve, these oracles verify the existence and valuation of the collateral in real time. If the value of the underlying asset drops, the smart contract automatically adjusts. This eliminates the need for expensive third-party auditors and creates a level of transparency that traditional finance simply cannot match. While real estate is the long-term goal, the gateway asset for the RWA boom is actually much simpler: U.S. Treasury bonds. In a high-interest rate environment, crypto investors wanted a way to earn the 5% risk-free rate without off-ramping into fiat currency. This led to the explosion of tokenized treasuries. Protocols like Ondo Finance and Franklin Templeton have brought billions of dollars of government debt on-chain. This allows DAOs and stablecoin holders to earn real yield, backed by the full faith and credit of the US government, all while staying entirely within the digital ecosystem. It is the first time boring traditional finance has become the hottest yield play in crypto.
The battle for RWA dominance reached a fever pitch when BlackRock, the world's largest asset manager, launched its BUIDL fund on the Ethereum network. This wasn't just a pilot program, it was a definitive signal. When a firm with $10 trillion in assets chooses to tokenize, the debate is over. BlackRock's entry has forced every other major institution, from JP Morgan to Citigroup, to accelerate their own RWA roadmaps. We are no longer looking at crypto projects trying to disrupt finance. We are looking at finance itself migrating onto the blockchain. The ecosystem is splitting into two camps, the permissionless DeFi protocols and the regulated institutional wrappers. Let's look at the leaders. Ondo Finance focuses on high-liquidity, low-risk assets like treasuries and money market funds. They prioritize institutional compliance and ease of use. On the other side, you have Centrifuge, which focuses on private credit and trade finance. Centrifuge allows businesses to tokenize their accounts receivable or invoices to get instant financing. While Ondo offers stability, Centrifuge offers higher yields by tapping into the massive private lending market. Then there's Clearpool, which provides uncollateralized loans to institutional borrowers. Each protocol is carving out a specific niche in the new on-chain credit economy.
The real reason institutions are obsessed with RWAs isn't just about the yield, it is about the efficiency. In the traditional world, settling a trade takes 2 days, known as T+2. It involves a web of clearinghouses, custodians, and manual reconciliations. On-chain, settlement is T+0. It is instantaneous. This eliminates counterparty risk, the danger that one side of the trade fails to deliver. By removing the middlemen, RWA tokenization can save the financial industry an estimated $20 billion annually in operational costs. This efficiency gain is the hidden driver that will eventually force all assets to be tokenized.
Now for the reality check. You cannot have RWA without regulation. This is the compliance layer. Unlike meme coins, RWA tokens almost always require KYC, know your customer, and AML, anti-money laundering, verification. This means you cannot be anonymous. These tokens are often issued under SEC exemptions like Regulation D or Regulation S. If a protocol tells you they are tokenizing real-world assets without a legal wrapper or identity verification, walk away. The regulatory burden is the price of entry for stability. This is why the RWA sector is growing, while other areas of crypto are facing lawsuits. They are leaning into the rules rather than trying to outrun them.
But even with regulation, risks remain. The biggest is smart contract risk. If the code that manages the tokens has a bug, the assets could be frozen or stolen. There is also liquidity risk. While you can sell a Bitcoin in seconds, selling a tokenized share of a warehouse depends on there being a buyer on the other side. Some protocols use liquidity locks or exit fees to prevent bank runs. As an investor, you must understand the lockup period of your RWA investment. Yield is a compensation for risk. If the yield is high, the liquidity is likely low. Always check the audit reports and the reputation of the asset issuer.
We are moving toward a world where every asset on Earth, from the art on your wall to the debt on your car, exists on a single, global, interoperable ledger. The RWA boom is the final bridge between the Internet of Information and the Internet of Value. For the long-term investor, this represents the ultimate opportunity to build a portfolio that is diversified across asset classes but managed within a single digital wallet. The volatility of the past decade was just the warm-up. The real game is just beginning, and it is backed by the very world we live in. The question isn't whether assets will be tokenized, but which ones you will own when they are.